Students, today we are going to solve the second illustration. First, I will read the question. On 1st April 2016, Messrs. Poonawalla and Company, Latur, purchased equipments of Rs 50,000 against check. They decided to follow fixed installment method of depreciation. The life of the equipments is estimated as 8 years and scrap value of the equipments at the end of its life is estimated as Rs 2,000. On 1st January 2019, entire equipment is sold for Rs 35,000. The firm closes its books of accounts on 31st March each year. Prepare equipment's account, pass journal entries for the third year and also calculate depreciation. Now students, here they have not given the years. They have just asked you to prepare the equipment account and pass journal entries for the third year. Now here it is given in the last sentence that the firm closes its books of accounts on 31st March every year. It means the accounting year ends on 31st March. So it starts on 1st April. Now in this case, the equipment is purchased on 1st April 2016. So this accounting year has started from 1st April 2016 and will end on 31st March 2017. So that is our first accounting year. Second thing, you have to find out from the question whether the rate of depreciation is given. In this question, rate of depreciation is not given, but then they have given the cost, estimated life, that is 8 years, and scrap value, that is Rs 2,000. So with this information we have to calculate the depreciation. Then we have to give effect for the further information about the equipment sold. First we will see how to calculate the depreciation. Here under working note 1, calculation of depreciation is given. So you have to remember, whenever the rate of depreciation is not given but then other information is given, at that time you have to follow this formula to calculate depreciation per annum, that is for 1 year. Formula is cost of an asset minus scrap value divided by estimated life of that asset. In the question, cost is Rs 50,000. Estimated life is 8 years and scrap value is Rs 2,000. So 50,000 minus 2,000 divided by 8, 48,000 divided by 8. Therefore depreciation per annum or per year is Rs 6,000. Then we are going to learn how to make the equipment account. First, we have to write the heading in the books of Messrs. Poonawalla and Company, Latur, equipment account. So this is the ledger account, which has got two sides, debit and credit, and the columns are date, particulars, JF, that is page number in journal, and amount. Same columns are repeated on the credit side, date, particulars, JF and amount. Then from the question we have to find out the transactions. Here it is given, on 1st April 2016 Messrs. Poonawalla purchased equipments of Rs 50,000 against check. Therefore equipment came in the business. Equipment is the real account, debit what comes in. In the journal entry, equipment account is debited, and since the payment is made by check, we have to credit the bank account because bank will be the giver. Entry will be recorded in the ledger as follows. Since in the journal entry equipment account is debited because equipment comes in the business, in the particulars on the debit side we have to write to bank account, and the amount we have to write in the amount column. Therefore you have to remember in asset account, always cash or bank comes on the debit side when the asset is purchased. And the depreciation is the loss in the value of asset. And depreciation is the nominal account. And the rules for the nominal account are debit expenses and losses. So in the journal entry, depreciation account is debited to asset account because asset loses the value. So in this case, the journal entry is depreciation account debit to equipment. We are preparing the equipment account, and as per the journal entry, equipment account is credited. Therefore, depreciation is recorded on the credit side of the equipment account. And full year's depreciation as per the working note is rupees 6,000. You have to remember that always depreciation is recorded on the credit side of the asset account. And the date should be the last day of the year, that is 31st March 2017. After recording the depreciation, we have to find out the closing balance, that is the difference in the total of debit and the credit side. Debit side total is rupees 50,000, which is higher than the credit side. Therefore, the higher total is written on both the sides, debit and credit, on the same line. And then two lines are drawn which indicate that the account is closed. Then again the same date, that is the last day of the year, 31st March, by balance carried down. This is the closing balance, and closing balance always is the difference in the total amount of debit and credit. Since this is the closing balance, we write CD here, and the amount is rupees 44,000. This closing balance will become the opening balance in the second accounting year. Two balance brought down. For the opening balance, we have to write BD. And the date is 1st April 2017. So our next accounting year starts on 1st April 2017. Two balance brought down rupees 44,000. Again, the equipment is used for full 12 months in the second accounting year. Therefore, we have to provide full year's depreciation. Again, the depreciation is recorded on the credit side of the asset account. And the last day of the second accounting year is 31st March 2018. By depreciation account rupees 6,000. Here the debit side total is rupees 44,000 and credit side here only rupees 6,000 is recorded. So the difference in the total is rupees 38,000, which is recorded as by balance carried down, that is the closing balance. For the closing balance also we have to write the last date of the year. This will become the opening balance in the next accounting year. And this total 44,000 is written on the same line on the debit and credit side, and after that we have to draw two lines to indicate that the account is closed for this particular accounting year. 38,000 is the opening balance on 1st April 2018. Then we have to go through the information which is given in the question. Here it is given that on 1st January 2019, entire equipment is sold for rupees 35,000. You have to check the date. The equipment is sold on 1st January. It means the equipment is used in the third accounting year from 1st April till 31st December, because it is sold on 1st January. We have to count the months from April till December. If you count, those are the 9 months. So we have to take the depreciation only for the 9 months. See, full year's depreciation is 6,000. 6,000 into 9 divided by 12, we will get 9 months depreciation, that is 4,500. Here we have to write the date on which the equipment is sold. Now you have to remember that when equipment is purchased, we write two bank account on the debit side. Therefore, when equipment is sold, we have to write by bank account on the credit side, because the journal entry is bank account debit to equipment, because bank receives the money and therefore we have to debit bank account. And when the equipment is sold, equipment goes out of the business, so we have to credit equipment account. 35,000 is the selling price. Here they have written the profit. How to find out whether there is a loss or profit on sale of the asset? See, from the original cost, that is rupees 50,000, we have to subtract the total depreciation. Total means first year's depreciation 6,000 plus second year's depreciation 6,000, that comes to rupees 12,000, and third year's depreciation 4,500. Therefore, the total depreciation is 16,500. See here the calculation of profit or loss on sale of equipment is given here. There is a printing error. Cost of the equipment is rupees 50,000 less depreciation for 2 years and 9 months 16,500. So the written down value or the cost on 1st January 2019 when the equipment is sold is 33,500. But then the equipment is sold for 35,000. See, the selling price is higher than the written down value. When the selling price is higher than the written down value, there is a profit on sale of the asset. Then here the profit is recorded on the debit side, because profit is the nominal account, it is the gain for the business, and the journal entry is equipment account debit to profit on sale. The journal entry is bank account debit 35,000 to profit on sale of equipment account 1,500 to equipment account, because equipment goes out of the business 33,500. So here profit on sale of equipment is 1,500 is recorded here. The total is 39,500. So in this manner we have to prepare the equipment account. Here the working is also given. Then the journal entries are given here. Depreciation account debit 4,500. They have asked to make the journal entries only for the third year. So on 1st January 2019 the depreciation we have provided. So the journal entry is depreciation account debit 4,500 to equipment account 4,500. Being depreciation is charged, you have to understand that depreciation is the loss in the value of asset. Therefore, depreciation account is debited. And since the equipment loses the value, equipment account is credited. Then the next entry is for the sale of the asset. Here bank account debit 35,000. To equipment account the written down value is 33,500. To profit on sale of equipment account is 1,500. Then this profit on sale of equipment account is transferred to the profit and loss account. On the credit side of the profit and loss account we have to record the profit on sale of equipment. Therefore, profit and loss account is credited. Then we also have to transfer the depreciation to the profit and loss account. You can notice that both these entries are recorded on 31st March. So all the transfer entries are recorded on the last day of the accounting year. Here profit on sale of equipment account debit to profit and loss account. And for the transfer of the depreciation, profit and loss account debit to depreciation account, because depreciation will be recorded on the debit side of the profit and loss account.